Good afternoon, ladies and gentlemen. This is Robert Rayburn here at Life Pro Asset Management. It is August 25th of 2022. And today was Jackson Hole Day as it relates to the Federal Reserve and Jerome Powell's speech. And it certainly wasn't pretty in the market. We saw the S&P 500 sink around 3.3% or so, and the NASDAQ down 3.7%. So markets, whatever Jerome Powell said, and which we'll go over those comments, the market didn't like it today. And we spoke about that last week, that we were expecting volatility this week, that we were expecting some ups and downs. Now, the good news is on a weekly basis. Now, if you remember, we always want to look at the markets from a weekly basis, not a daily basis, because a lot of times that daily noise can really throw us for a loop. On a weekly basis, there was actually a lot of very constructive activity that took place at the sector and the individual stock level. To kind of give everyone an idea, we saw the S&P 500 this week sink about 4%, the NASDAQ sink about 4.4%. When we look at our growth portfolio, which is pretty volatile, it was down about 1.33%. We're starting to see, like, again, down days, up days, some constructive activity take place in certain areas of secular growth, such as alternative energy or biotech and healthcare, and then select areas within that consumer space. Big cap tech continues to act weak, and we're going to go through all of that this week. So the title of this week's presentation is Jackson Hole, Now What? Yes, the market was weak today, but the positioning across the board right now is hyper short. We want to be cognizant of that, so we don't necessarily want to be running around with our, like a chicken with its head cut off. We want to remain focused on the week-to-week action, the month-to-month action in particular. So this week, we're going to go over specifically what did Jerome Powell say at Jackson Hole. Also, how can the actions of the Fed impact asset allocation? And it can impact in ways that we don't really think of right off the bat when we're looking at those red numbers like we saw today. And then lastly, what is the state of the housing market and overall investor positioning across the stock market? So what did the Fed say that got everyone really rattled today? Well, the first was restoring price stability will likely require maintaining a restrictive policy stance for some time. Okay, let me translate that for you. Restrictive policy stance basically means once interest rates get above a certain level, they begin to take away from GDP growth. In other words, GDP growth begins to sink the longer that interest rates are in that zone. So in other words, growth is going to slow, and that's the policy of the Federal Reserve. Number two, the historical record cautions strongly against prematurely loosening policy. So in other words, restrictive policy for higher and longer. Then honestly, I think you're going to read that longer than the street expected, but I think a lot of the rhetoric going into this was that the Federal Reserve had to show resolve. And if you remember what we talked about last week was we want the Federal Reserve to say this because inflation's the problem. Inflation is what the market has gotten into a tizzy about. So we want to kill off inflation. So the more commitment they show, the better it is over the long term. So bottom line, the Fed is focused on lowering demand. So that means lower GDP and by proxy over time, ideally lower inflation. But that also means probably weakness in those more cyclical areas of the stock market. Now, as it relates to the US economy and the US consumer, this is a chart of total estimated home equity across the US. Now, yes, housing starts have dropped as mortgage rates have risen across the country, but the total home equity, even if housing prices come back in, say even 20%, is significantly higher than it was at the prior peaks in 2005 and 2006. So I think that's like a very important detail when we're thinking about the health of the overall US consumer. And so what we see here is what has been that weakness in housing so far. We see there on new single family home starts. We've seen a significant drop off in terms of the rate of change of new home starts. It is definitely slowed down. And that's a good thing when we think about where the Fed is trying to take this economy, where the Federal Reserve is trying to slow things down when it comes to an inflation perspective. And we also see that in terms of the affordability. So this secondary line here is the mortgage payment to income ratio. And what we can see is after the rise in mortgage rates, the affordability of housing across the US is back to the least affordable levels that we saw back in 05, 06, and 07. So immediately people are going to say, is this another 2008, right? That's sort of the immediate reaction. Now, in 2008, though, there's a key difference. Mortgages were poorly underwritten, very poorly underwritten. Hey, if you were breathing and you showed up to the bank, you got a mortgage, you got a big one, right? Versus this time around, what we're seeing is that mortgage credit availability is actually relatively low compared to that peak in 2006. So mortgages across the housing industry have largely been very well underwritten when you look at the stats, the credit standards, et cetera. So completely different picture than what we saw in 08. 08 was a credit story where the underlying credit of the mortgages that were underwritten was very, very poor. So the credit quality was bad. This time around, credit quality is really good. The affordability of the housing market is an issue. So that means likely some price softness in the housing market. And if you're in the market for a new house, that's a good thing. But for those who rely on home equity, it's probably a bad thing over the short term. And then here what we see is just overall credit spreads this time around versus 08. And I wanted to kind of show people this is that, obviously we talked about credit risk on a weekly basis, but this was implied credit risk back in 2008, really blew out, right? Like this was the entire system's falling apart. This is where we're at today. And then back in here is where we were during COVID 2020. So again, yes, the credit markets have backed up a little bit. Again, this is nothing, absolutely nothing compared to what we went through in 2008. 1-year inflation swaps near 52-week lows. Again, I think we're going to see that deflationary shock hit the system here over the next couple of months. And that's really something that a lot of people are not pricing into their models. And I think one of the reasons why you've actually seen growth stocks actually hold in quite decently in a relatively weak market this week. Now, as we go into the weekend, go into next week, I can't tell you that Monday won't be bad or Tuesday won't be weak. But what I can say is the market is really, really short. So when we look at the levered net long, net short positions of the S&P 500, very rarely have we seen investors this short. And we have to go back to 2015, 2016, and all the way back to 08 before this chart, before this chart kind of shows the data there. So very pessimistic behavior across the market. That's generally a good contrarian indicator. We look at long short beta relative to the S&P 500. What does beta mean? Beta means, hey, if the S&P 500 goes down 1 and you go down 2, you got a beta of around 2. You got 2 times the risk of the overall market. So right now, you see long short funds are paring back their beta risk all the way, believe it or not, 0.1. So remember, 1 is your market level exposure. Long short beta right now is 0.1. So very de-risked books across the board. Macro funds are actually almost net negative in terms of their beta exposure. They don't have a negative beta. So you just don't see this kind of stuff very often. And when you do, that's kind of when you want to start chipping away at some stuff. Now, as it relates to sector work, reading the tea leaves here, a couple themes. Energy and alternative energy continue to break out relative to both the consumer and the technology space. You'll notice within our own portfolio, for those that are invested in our growth portfolio, over the last 5 to 6 weeks, we've been using strength to scale out of some of the higher value technology names. We let that short cover rally allow for some price recovery. We've then been rotating out of those names on strength and into, in particular, alternative energy, biotech, healthcare, those types of areas of the market that are showing a relative resiliency, both to the upside and downside. And we can see here, consumer discretionary relative to energy, again, broke that big trend line, and then tech relative to energy, backtracking quite a bit again. I think Google, Microsoft, those types of stocks were down almost 3, 4, 5% today, which is quite unusual. Now, within the energy space, we like alternative energy. Now, if you own the blue chip portfolio, you'll notice more traditional energy, oil and gas in there. But within the growth portfolio, we're focused within the energy sector areas of secular growth. And that's where we think alternative energy is well positioned. Again, these solar stocks continue to act great. We believe they are a secular growth component within the energy sector, definitely being supported here by one of the most prolific government support packages over the last century. So again, don't fight the tape, don't fight the government, go with it. And alternative energy is going to be here to stay. And so we want to invest in some of the leadership names there. Biotech is another area that we continue to like. Again, off that bottom in May, what did we see? We saw almost everything start to rebound, but biotech in particular has been acting better. And we look at biotech relative to the S&P 500, definitely broke that downtrend line. Down today like everything else with the market, but again, a lot of the individual issues within the S&P 500 definitely holding in quite well. So the bottom line is Powell reaffirmed that Fed commitment to bring down inflation. We think that's a good thing. Restrictive monetary policy will, we think, lead to slower GDP growth. Low growth is historically not great for value stocks, so be cognizant of that. Some more cyclical stocks that need high GDP growth. Where it is good for is secular growth stocks. So stocks that can grow in a low growth environment. Also, possibly good for bonds with higher duration. So we do think the long end of the curve will start to come down in terms of those interest rates, while the short end will stay high because of monetary policy. So we will likely try to increase duration a little bit in the more conservative portfolios. So that's what we got for you this week. If you have any questions or concerns, number is 888-543-3776. And otherwise, have a great weekend, and we'll talk again next week. Have a great weekend.